welcome to the Inner Circle Boardroom's Backstage Pass. If this is your very first time here, a very special and warm welcome to you. My name is Kate Chohan. This is a platform you'll find me in discussions with investors and boards. I'll be unpacking their views and approach to shifting operating models, turnarounds and scaling businesses. I'll also bring you the latest thinking into the market gaps and opportunities. So today we're going to have a bit of a different spin on it. In fact, what I've done, just because myself and Mike have been speaking and helping a number of boards around looking at debt, looking at restructuring. So what I thought I'll do on this occasion was invite Mike on. Now, we know that many business owners and operators will be looking for potentially an exit for one reason or another. So whether it's retirement plans, they're over leveraged, maybe the business has been mismanaged, maybe it's just an entrepreneur who's fed up now. So both myself and Mike, we've been working with both existing and new players, and we know that some of those businesses are looking to excel and grow or diversify their portfolios. So those of you who are looking to do that will be looking to capture market opportunities over the next coming months. But in order to do that, you need to sort of start preparing your finances so you're in a good position when you need to buy it. So with that said and done, I wanted to bring Mike on board and talk about some of the deals that we're dealing with, just so you can get an idea of how we're helping some businesses structure and think about their thinking around finance effectively. So Mike, just for the sake of our audience, can you provide a bit of background in terms of who you are?
Will do. Thank you, Kay. Hello, everyone. So I'm a career corporate banker, 35 years in the profession. Part of that working in structured finance roles, working with private equity at Royal Bank of Scotland, and then latterly built the corporate and commercial banking business at Santander. But during that time, my area of real interest has been the mid-market. So companies turning over 5 million through to 100 million, raising 2 million to about 50 million of debt. So that's the real sweet spot. And it's a market that's changed a lot over the last few years with lots of new players, banks, non-banks, platforms, funds, all sorts of different people offering solutions to the mid-market. So I've spent a bit of time the last couple of years helping companies navigate that space.
Let's just talk money and business. How should business owners or operators be strategically approaching their refinancing strategy to have the best foot forward?
I think it's understanding what it is they're going to need over the next few years. So having a real clear view of where they want to take the business, what they want to do, understand the amount of money that they need to borrow, and then seek out the best people to provide that. And the days are gone now where that would have been one of the traditional four banks. It's about tailoring their requirement to what the company needs and a product that suits it best. So spend a lot of time trying to understand that, have the information. So, borrowing requests are best received when the company's got lots of information to support their request, to give them comfort around the areas of cash flow and security if that's necessary.
Where do you often see gaps when businesses are looking to structure refinancing deals?
Externally, the gaps are often in really understanding their market. So where do they sit within their market? Who's their competition? What are the trends emerging from within their market? And the real competition might not be from the people that they've been competing with for the last few years, but from new players, different sources, different platforms, that sort of thing. Internally, I think sometimes the gaps are not having the data analysis and information behind their forecasts. So what works best with lenders is knowing how your forecasts are built together and what data have you captured to underpin that in recent years. So what I'm working on at the moment is a business that needs to raise some money post-COVID. The business managed to get open in between the lockdown periods, and we're using the data that we had around bookings and operations during that period to underpin the next 3 to 5 years. So you've got a real reference point for lenders to go to.
Can you give some more examples around how you're helping some of those businesses that put that proposition together and then go to market, just so people can get an idea?
Well, the first bit is, I think, is to stand back and say, how are you going to present your business? So have a real clear view of what your business is. Make sure things like the website are up to date, because people will do their own due diligence offline. So make sure that's up to date and consistent with the picture that you're giving and painting. Be clear about where your product is, where it sits in the market. Be clear about who your customers are. Think about whether you can have some customer references to help support the view of a well-managed business. Don't underestimate the strength of management. You want to show a breadth of management, a breadth of skills, depth in numbers, experience in areas, but also bring in some kind of new blood in, and how you will manage succession issues. So think about the management piece. It's often forgotten when people put it forward. And then look at presenting the cash flows in a strong light, and think about the assets of the business and how they might be used to arrange alternative finance. So that the package you put together, rather than being from one bank like it used to be, might have 3-4 different providers, all tailored to the right areas, such as assets and cash flow.
So, Mike, I also want to talk about portfolio diversification. There's a lot of businesses out there pivoting, taking a new direction. What advice would you give to a business leader who's looking to do that and looking to get some lending support in order to be able to have new growth plans?
Yeah, if they're diversifying away from their core business, then I think there's a couple of areas they need to think about. First is, why are they doing that? And then, provided there's a good rationale there, how are they going to use the skills and experiences they have in their existing business to mitigate the risk of going into an unknown area? And what else will they bring in, whether that's people or support, consultancy, whatever, to help them navigate a new arena? So think about the two, because it is a risk area. Now, it might be the right risk to take, and the business might be in a great position to do that. But think about doing kind of an analysis of your existing business, what you have, and then what gaps you've got. And then when you go to the lender, you talk about how you will plug those gaps, whether that's from internal experience or whether it's from the external market. But more than anything, there needs to be a real clear rationale as to why this direction is the right direction for your business.
What's the key to a successful financing strategy?
It's about having the right data and management information, so that the right numbers and spreadsheets and everything else to articulate the financial position. I think it's around using your management team in presentations. So show the breadth of your management team and the strength. So for the right areas, have the right people speaking and present. And then I think a clarity of vision also helps. Take people on the journey with you where you want to go, and make it a really compelling vision. Practice it. A lot of people don't practice it, but kind of have a pre-run of 2 or 3 goes in front of different people. Take their feedback before you sit in front of the funders, because that impression, it's an old cliche, but it still works. You need to give the funders confidence that you know what you're doing and how you're going to use the money. So have a really polished presentation.
We know that a lot of small to medium-sized businesses will have a small finance function that do a great job, but often quite transactional. Or you tend to find these businesses will outsource to a preferred accountant, perhaps. Many of those accountancy firms may not actually have an M&A or corporate finance individual who advises that business. What skills and capabilities are often overseen but essential when going for refinancing or some sort of debt financing solutions?
I think it's probably, we all work in local markets, and we know our local market and well known, and we're comfortable with the people that we know. And I think one of the things that's often overlooked is a proper view of what's available in the market. So, let me try and give you an example. In the hospitality arena, there are lots of physical assets, hotels or whatever, that might be available, traditionally funded on commercial mortgage from the large banks. One area that I've spent a bit of time working on recently is the development of the ground rent space, where an institution will provide a chunk of money for a guaranteed return at the safer end of the spectrum, but it provides long-term debt, non-amortizing, which works well for these types of businesses. You then look for lenders who will provide funding against the long-term lease that comes as a result of that, and you end up with a package that's much better suited for the industry. What I see too often is in localities is people just going to the network that they already know for the solutions that they've had 10, 20 years ago.
There are some business leaders who will be exhausted and they will be looking to exit for one reason or another. What advice would you be giving to them about getting ready for a sale?
It's a different end of the spectrum, but the same thing, which is prepare, don't make it rushed. Have your information ready, have a due diligence pack ready for potential buyers to come and see. Make sure that everyone understands the reason for sale, and don't be in a hurry around it. If you want to get best value, don't be in a hurry. But think about, start thinking about who might be the potential acquirers of your business years in advance, and think about if they're going to buy it, what are the things they'd like to see, and make sure for the 2 or 3 years prior to sale that you've developed those areas to make your business attractive. It might be a management team again. It might be having the strength in depth and succession through the management team. It may be around margins. Maybe you need to cut some lower margin business out of your base and make it look different. But think about this a few years in advance and get it into shape before you come to the day that you're going to sell it.
What questions should owners and operators be asking when they're looking to raise capital?
Of the funders?
Correct.
Yeah, no, I think it's an important point, because I think alignment's really, really interesting. So understand the terms on which you're going to get the finance. People will often judge a finance package probably by the price of it. So what interest margin am I going to pay? Actually, more important than that is, well, what are the covenant controls around that? How much headroom against my business plan are you going to allow me? Because it can be a bumpy road ahead, and I don't want to bust covenants in the first 6 months or so. I don't want to bust them at all, actually. So think about the track record of the funders around customers who've got into trouble. So how do they treat people? You don't want the loan to own, where somebody will give you the money but covenants are tight, and as soon as they bust, they take the business from you. So think about the alignment you have, the relationship you have with the individuals, and how you tailor that product best to the business plan that you've produced.
What do you tend to find that investors are looking for when looking to finance a deal?
It depends. For the people at the debt end of the spectrum, the lenders, they want real stability of cash flows. So people will often talk asset values. In reality, what their best security is cash flow. So anything that's got a good stability, recurring revenues works really well, and you can leverage more against that. If it's on the equity side, again, it depends a little. If they're looking for high return, they may take more risk. So, there's an awful lot of money chasing around disruptors in the technology space right now, and almost anything in that space will gather a lot of interest. But they're looking for high multiples. There are others who are perhaps around more yield driven, and then more like the debt lenders. So they'll want to say, well, if we can get a 5 or 6% return for the investors behind our fund, then we're quite happy with that. So it doesn't need to have the same growth prospects, but what it does need is stability of cash flow, so they know the dividend is going to be paid out, and they know they can pay the investors when it falls due.
And where do you see refinancing strategies often go wrong?
Not leaving enough time to do it, so up against the clock and not having information ready to do it. Probably needing too much at refinance and not understanding where the provider is. So potentially banks where they've had high hold levels. So at the top end of the market I've talked about, it's not uncommon for customers to have 2 banks, maybe holding 40, 50 million pounds each, and then going into a refinance and not realizing that the bank's appetite is going to be more like 30 million, and you need another bank on board, and they don't leave enough time to do it. The second bit is probably just not having the information ready for the banks, and not being able to drill through their forecasts, the assumptions on their forecasts, and having reference points to underpin those. Almost taking it a bit for granted that it's refinanced, so someone will do it, rather than actually treat this as a new case, present it properly, have the information ready, and articulate your case very carefully.
What are the top 3 mistakes businesses make when they're looking to grow?
I think one is growth for the sake of it. So not actually understanding why it is they want to grow, and taking too much risk as a result of it. The second one is underestimating the management stretch. So you have your core business to look after, and yet you expect that existing management team doing a great job looking after your core business to drop all of that and then go and integrate an acquisition. So very often we see things go wrong in that integration phase. The third one, I think, would be not reacting quickly enough when things start to go wrong. So if you've got a plan, stick closely to the plan, and when things go wrong, start to address it. Don't leave it a month and see if it'll get better. They're probably the three biggest areas.
Mike, there's a lot of misconception around debt and debt refinancing, debt structuring. You've worked a lot with debt. What would you say to anybody who's listening in and has some misconceptions around debt?
So debt as a product and as a tool to help manage your business and grow is a good one, but it needs to be used sensibly. So think about the cash flows of the business that you're either going to have or going to acquire. Think about what could go wrong, sensitize your cases, and then look at what is the right quantum of debt, and also think about the shape of the debt. So are you borrowing long term? Is it a short term piece? Think about the people that you want as partners in that debt relationship. So look at their track record, look at their customer satisfaction scores, look at what people say about them, test your network, test the market, because if you're going to take these people on, make sure you can work with them. And then the two of those things combined then to make sure that the covenant and control framework around that debt is something that your business can manage. So if there are bumps down the road, actually you've got some headroom within that, so you don't trigger any kind of covenant breaches or anything of that nature.
Mike, you've obviously come from a banking background. You've been working with corporate and commercial functions. So you've been building those. I know that you have built, for instance, Santander to be a £25 billion asset portfolio, which is huge in itself. What is your take on currently at the moment in terms of interest rates? Do you think, how should businesses be thinking about interest rates at the moment? There's obviously a lot of talk around whether it's going to go up or whether it's going to stay the same. How would you be thinking about interest rates if you were running a business at the moment? And what would you be saying to any other business leaders right now?
Yeah, so absent a crystal ball, I don't really know. It's you can't. The economy is going to need an awful lot of stimulus over the next number of years, even from where it was. So we hadn't really got rid of all of the quantitative easing from last time. As we come out of this pandemic, and as we stand now, there's still an awful lot of people furloughed, no idea whether there's a job to go back to. So what happens to unemployment, I don't know. It's uncertain, even with the vaccine, whether we get COVID under control this year or even next year. So huge amounts of uncertainty. So I think the economy is going to need quite a stimulus to get it going. That would suggest that the likelihood of a rise in interest rates is slim. However, there is a school of thought that says the only way out of the amount of government debt that's been taken on across the globe is to actually inflate your way out of it, and kind of inflate the economies to be able to deal with what is a relatively lower amount of debt. Now, I'm no expert in this, so I don't know how that would work. It sounds like there's an awful lot of risk in that, but you could see a surge in inflation and interest rates after that. So interest rates could rise. So my advice would always be, if you're borrowing money, is to think about the most appropriate way of fixing the cost of that money for the period through which you're going to borrow it. So is that a fixed rate instrument that you take? Is it a hedging product from the banks that will allow to cap the rate of interest? But try not to expose a business plan to what could be rapid rises in interest rates, because if the likelihood of that happening is low, then the cost of insuring against it will also be low. And therefore, I would say, for a peace of mind, it's worth doing that. For instance, you wouldn't take a risk on fire insurance on your property. So why would you take a hedging risk against interest costs on your business?
Mike, obviously you come from a banking background. You've worked with businesses where they've traditionally come to you and said, hey, can you loan us some money? What would you say to anybody who's watching this and looking at someone with your skills and expertise that they should be thinking about around the people they keep around them in terms of making sure they cover all blind spots?
I think it's so. So the first bit is in understanding what team you have within the business right now and what their capacity is. So very often in the market space I've talked about, you don't have an M&A team, you don't have a full finance function in a lot of cases, and actually they're really busy doing the day job. Therefore, you need to assemble a set of advisors around you who can look at the more project element of what you're doing. So if you're thinking about an acquisition, actually talk to these guys, get people on board who can advise you around the right place in the market to go, the types of products that are around for you to use, and look at having a blend of the internal team with a few external advisors and use them as you need them, rather than kind of beefing up the team and paying for it permanently. Actually, just it's a pay as you go model, I guess.
Previously, people would be trying to get somebody who's worked in a particular industry. Do you think that's important when you're raising money? Especially when there's so many new lenders and players coming in. Is it important that you have an advisor on your board that comes from that particular industry? Is that essential nowadays?
It's not essential. I think it helps. I think particularly in a growth scenario where you might have a more inexperienced management team, knowing that there might be somebody with industry experience who's been there, seen it, done it, got the scars, actually in a mentor advisory, non-executive type capacity. I think that's important. But equally important, I think, is to have somebody with alternate views and skills. So actually, they're not blinded by how the industry's already operated. They bring a different perspective to it. So it's a mix. It's a mix of both, I think. But young management teams can always benefit by talking to people who've been through that journey, and still have relevant experience to help guide them and still keep themselves current. So I'm not talking now about the usual, you come to the end of a banking career or end of an accountancy career and the next step is to go on a board because that's just what everyone does. Actually, you need people who are going to keep themselves current in the markets in which they operate, but can blend their experience with what's happening today to give the management team the best guidance.
Have we missed anything off that you think that we should be just mentioning? Is there anything that you think that we might have missed off?
No, I think we've covered a lot. I think be transparent. A lot of people are keen to keep stuff from the potential funders that they're talking to, but the reality is most people with good due diligence will arrive at the area, and it's much better that if there is an issue to address within the business, you're transparent about it and understand what the mitigants are. So that's probably the only thing that we haven't discussed.
Transparency is obviously very important, especially when you're looking to raise.
Indeed.
So, Mike, thank you very much for joining me today. Guys, look, I hope you enjoyed this. Again, we made this for you. We wanted to get information out there so it's current. You guys are getting a bit of insights around the conversations we're having. Feel free to get in contact with us if you are looking at refinancing or debt finance solutions. We'll be happy to have a conversation with you. Mike's been obviously consulting some businesses as well to start think differently about with alternative solutions. So more than happy to have a conversation. If that resonates with you, we hope you found this useful, and thank you very much, and keep looking out for the content that we produce. Thank you. Bye bye.